Have valuations for companies like Facebook and Groupon spiraled out of control? Billionaire stock picker Warren Buffett told investors last week they should be wary of valuations for social networking firms, saying most of them are overpriced. That feeling isn't necessarily shared by the countless venture capitalists flocking to Silicon Valley with hopes of finding the next big thing. Joining us now to discuss valuations and the potential bubble that some see on the horizon here in the Valley is Jeff Yang, founding partner of Redpoint Ventures. Jeff, welcome to Bloomberg West.
Thank you.
So Redpoint has actually stayed away from these most talked about social media companies like Facebook, Groupon, Twitter. You've hesitated from going into the second markets, getting into these companies at a late stage, but your competitors have jumped in.
Right.
Why did you decide not to go after these companies, and was that the right move?
Well, I guess time will tell whether or not it's the right move. I think making the case for it, I mean, these platforms are really, very large companies, and potentially technology used to be more of going after niche markets and going after smaller markets. And today, what's happened today is technology is really in the mainstream of kind of everyday people's lives. And we're now addressing larger markets than we've ever been able to address. And so for venture capitalists like us, we've got to adapt to, getting used to these enormous markets and what valuations, may mean. And traditional metrics of what is a large valuation are really kind of changing. We haven't gone into making those secondary purchases or in highly valued late-stage companies, typically because we haven't been comfortable with the overall magnitude of the valuation. It's not to say that it couldn't potentially be worth that. We're just not comfortable playing in that sphere. We're much more comfortable with startup valuations and startup companies, and even those are beginning to inch up substantially right now.
You're an active tweeter, and
Yes.
You tweeted last month that you heard as much as $1 billion in Facebook stock is on the market. Is that still the case? And tell me how this stuff gets kind of marketed, bought, and sold.
Well, Facebook is a private company, and there are a couple ways that positions trade in Facebook. The first is direct placements into the company, and so the company will issue primary shares to somebody coming in as a new investor. Very often, as part of that transaction, the investor coming in will also buy out some of the existing shareholders, and thus creating a market. But what has happened over the last few years is the creation of a secondary market in private companies. For instance, a company like Second Market provides liquidity out there in a bidded market, and so there's a lot of liquidity changing hands.
Jeff, why not use that liquidity at least around the margins of your position and maybe take some off, put some on if you thought the valuations were attractive? It changes the math of being a venture capitalist, doesn't it?
It really does. I think it makes, for us, as I said, we're traditional early stage venture capitalists, and so we're much more used to, smaller numbers, and both in terms of valuations as well as check sizes, which isn't to say that it isn't a good investment. If you're an existing investor, looking at these lofty valuations, it might be a good time to take some of the risk off the table and cash in some of your position. As a new investor going in, it's hard to say. The projections that eMarketer has in 2015 for the online ads business is a $45 billion a year business, and that's a pretty big business. And if you look at Facebook, it's kind of the dominant platform, and the question is, what share of that revenue could Facebook attain? And with something inherently like a 35 or 40% pre-tax margin, it could be a very valuable company because it has the opportunity to grow a lot and it has the opportunity to generate a lot of profits. And when you look at Google at $190 billion valuation, I think that's what a lot of new investors coming in are saying. I don't know if 50 billion or the reported 85 billion is the last trade I saw in Second Market. I don't know if that's a big number or a small number, but compared to 190 billion, that's there's still upside there. And if you look at Facebook as a proxy for the internet, and if you look at Google as the past proxy for the internet, I think that's some of the thinking that's going through people's minds right now. For us, we're just not great at that type of business, and I think we're much more the startup people.
Facebook has been valued as much as $80-some billion
Right.
on the secondary market. But first, let's get to this question about the bubble. TechCrunch reported today that a Facebook employee was pushed out of the company because he may have been involved in inappropriate trading of Facebook shares on the second market. As a follow-up to that, Vivek Wadhwa, who's a tech columnist and academic, tweeted, "The type of money sloshing around in Silicon Valley is really worrisome. It will, without a doubt, corrupt. We will have our Enrons." What do you think of that?
Well, it's very hard for me to comment on it because it's really not a very transparent market, and what happens and the amount of liquidity, I don't really know. Right now, none of that's regulated, so it's kind of hard to say.
But in terms of some of these hot private companies,
yes.
Do you think that one of them will eventually crash? One of them will not be worth what these secondary markets are saying they're
yes.
worth?
Undoubtedly, that's the case. Right now, it started with the biggest platform-oriented companies getting the highest valuations, and that created an umbrella for kind of all the other companies to kind of rise in valuations, which usually happens when you get dramatic rises like that. And undoubtedly, some of the valuations being paid, are too high, and there's still risk in many of these companies until they're profitable and until they're generating cash. There's still risk that they can go out of business, and so undoubtedly, some of these high flyers will not make and will crash. And my hope is that people who are investing are smart about what they're investing in, and if they are doing it, they're investing in a basket of these types of companies rather than any one individual company.
So consumer-facing internet on the private side, very expensive.
Yes.
Maybe other things aren't because smart investors go to where people aren't looking. Where do you look to make investments right now on the private side? What's really attractive to you right now in terms of a sector in the private markets?
Well, I think one of the things that's really exciting about what's happening right now is that many of the sectors in which we invest are growing extremely rapidly. And the rate of adoption, not just with, at least on the consumer side, it has really hit mainstream, as I was talking about earlier. And so these segments are really growing like crazy. So you have on the social side, everything from social content to social commerce to social platforms are still growing extremely rapidly. Mobile and the integration of mobile and social is really an exciting trend. And you could argue that the migration to mobile is as large as the migration to social, and that the two are in fact one market. Then if you look on the enterprise side, you have the onset of on-demand infrastructure, which is arguably the most significant architectural shift that enterprises have had over the last decade.
What does that mean? On-demand? What is it? On-demand?
On-demand infrastructure. So basically, you used to buy an individual server, or you would buy bandwidth, or you would buy storage, and you would manage it yourself and in chunks of capacity. What on-demand is the ability to kind of buy it, as you need it, without having to own the server, without having to own the storage, without having to own the bandwidth. It's as if you're buying electricity from the electric company instead of buying a generator, in your own home. And that changes, significantly the economics of starting a company. It changes your capabilities and your elastic capabilities to grow with demand. And so you see large enterprises really changing their model of computing, for more of an on-demand basis. And so that is a significant change. The fourth is emerging markets. You see that a lot, and then the last is new energy and the environment.
You did just come back from China, and where are you most excited about investing in China?
Well, on the big picture, China is just an enormous market with a rising middle class. And then the thing about China is everything is big in China. So the opportunities for a lot of the things that you see here on internet media and e-commerce, as well as energy and the environment, are huge opportunities. We had a company, in fact, go public just the other day on the New York Stock Exchange, Chihu. And after the first day of trading, it was worth almost $4 billion. I mean, this is a substantial, internet company. And so there are a lot of big opportunities. But China isn't the only market that's interesting. I think some of the countries in Latin America, notably Brazil, is a pretty interesting, growing market. And those are interesting places.
All right, Jeff Yang, founding partner of Redpoint Ventures. So much more we could talk about. We'll just have to have you back here on Bloomberg West. Thank you.